Industrial real estate has a problem. And when I say something like that, I feel like there should be a news banner or something right here. It's not that Amazon is expecting to throttle their demand for warehouse space, nor is it the update from Prologis that they expect industrial lease rates to rise another 10% this year. While it may seem somewhat contradictory that the largest user of warehouse space is planning on slowing down at the same time when the largest owner of warehouse space is predicting another big increases in lease rates, that is not the problem. Instead, the problem is that anytime news happens regarding warehouses, it's automatically assumed to be reflective of the industrial real estate market as a whole. And it goes the other way too. All we need to do is look at a market update for a city anywhere in the world. Let's pull up Los Angeles as an example, where we'll see that the vacancy rate for their industrial market, at least according to this one recent report, is 1.4%. So here's the problem. There are two main subcategories of industrial real estate: warehousing and manufacturing properties, and they each have unique profiles. And it's the fact that they don't move in lockstep with one another is the exact reason I've talked extensively of the importance of differentiating these two subcategories. To illustrate a section of the manufacturing component of the industrial real estate market, I recently interviewed Jeff Golanowski, Vice President of Engineering with Tier 1 Energy Services, to get his take on the current state of the oil and gas industry. Jeff shared a number of great insights, including what he sees in store for 2022. Stay tuned until the end as well, as I have a prediction for the industrial real estate market as well. If it comes to fruition, I think there's a real opportunity for industrial real estate investors to look into right now. Not surprisingly, the depressed oil prices over the past 6 or 7 years have wreaked havoc on the oil industry.
So over this course of this downward cycle in commodity prices, oil and gas companies were the first movers to reduce CapEx, drilling, everything, their budgets all got reduced heavily. And then following that, oil field service companies, that work wasn't there, so they had to then reduce labor and staffing. All of that declined. There was closing of offices, closing of districts. And so that's the sort of the cycle that oil and gas companies go through that are sort of, they follow suit of the commodity prices. When commodity prices are up, drilling activity is up and labor increases, supply increases. And so through the 7 years, what we have seen is the industry become very much like work hardened through these ups and downs, where capital discipline has become critical. And I'd say the previous, where oil and gas companies were being incentivized by their share prices increased through production. So you'd increase production, you drill more wells, that's how they were being rewarded. Now, those metrics do not work, and oil and gas companies aren't being rewarded through their share prices by increasing production. It's now through capital discipline, through ensuring that they are cash flow positive, balancing budgets, ensuring that they're paying off debt. And we're seeing this here as the commodity prices have increased dramatically, kind of at the tail end of 2021, where companies are buying their stocks back because they feel like they're undervalued. And this model of having capital discipline and working smarter, utilizing the resources that they have, that's been the big change sort of over the last 7 years of this downturn of being smarter with the deployment of capital.
What's interesting is that this massive slowdown has led to a dramatic underinvestment in the industry. And now that demand is picking back up, we're seeing prices rise right alongside that. Oil prices have increased 50% over the past year, going from $60 a barrel to over $90 a barrel. And with rising demand and geopolitical risks, it may even rise over $100 a barrel in the near future. As Jeff states in this next clip, an important trend will be to watch rig activity.
Rig activity has been consistently increasing like week over week in Canada and US land for quite some time now. And so things are moving in a positive direction in this like upcoming cycle, this uptick. How quickly can we bring production online? to match the forecasted demand. I think that's where we come back to this labor, equipment, supply chain. I think it's going to take longer, and what we'll see is the prices are going to increase until this problem gets solved. And this isn't one simple answer to solve the complexity of this. It's an industry that's so involved. There's so many touch points that a lot of things need to be fixed before the entire industry starts, humming along.
One last point worth emphasizing is that the oil and gas industry is a massive machine, and it goes well beyond just the areas that have oil reserves. In fact, there are oil and gas service companies located all over the world, even in areas where there's little to no oil reserves whatsoever. That's why it's important to have a good understanding about the differences between the upstream, midstream, and downstream industries.
The upstream, this is where you see oil and gas service companies. That's where they're doing things at the wellhead. So if you're driving down the road and you see the pump jacks, that is part of sort of the upstream business, where you see drilling rigs, where they're drilling wells, they're doing completions, they're producing these well bores. Midstream is your pipeline side of the business, transporting oil or hydrocarbons from A to B. And then downstream is refineries, where they are producing or going through the refining process to make aviation fuel, diesel, gasoline, things that commonly we interact with as a society, and then also doing plastics, manufacturing fertilizer. This would be part of that downstream refining business, and these again are enormous, complex energy infrastructures that are all intertwined, that we see the products of.
This all leads me to believe that supply chain issues will still reverberate through 2022, but I think an even bigger issue will be the impact oil prices have on the industrial real estate market. Provided oil prices stay high, this will mean more demand for the manufacturing side. And since it's unlikely that a meaningful amount of inventory will be able to hit the market in the immediate future, we'll see more demand for both warehouse and manufacturing properties.
We always ensure that we have enough space for the headcount and equipment that we have in a specific location. And again, when we see activity increase and we need to add more headcount and more equipment, we soon realize that we always run out of warehouse space or shop space and yard space, and so we look to then increase our footprint from that standpoint. So in certain business segments that we are involved in, and in certain locations, yes, we are actively looking right now for more yard space, more shop space, and so again, that is a very positive, opportunistic problem that needs to be solved. That's an enjoyable one versus having too much yard, having too much shop, and paying the lease on that when you're not utilizing it. In addition to that, where we need to start looking for spaces if we want to expand to different districts or different cities or provinces or states type of thing. So if we feel that equipment or services that we provide are going to be in demand and we don't have a physical footprint there, we will naturally then hire people, get space, move equipment or buy new equipment, staff that area for us to then start growing our presence in that operating area.
It's purely a guess, and don't rely on a guy sitting in front of a bookshelf, but I believe there'll be downward pressure on vacancies and upward pressure on rental rates across the entire industrial real estate spectrum. An idea that might be worth exploring is looking for areas with high amounts of oil reserves and see if the market has yet to price in the seemingly quick increase in commodity prices. A lot of distribution-type warehouses are already at all-time highs, but there might be an opportunity to buy manufacturing properties at more attractive prices right now. There's a lot of due diligence beyond simply identifying markets with potential, but if oil prices remain at this price, or conceivably go even higher, then there's a chance that manufacturing type properties will see a similar type of lift, especially if the real estate market isn't already factoring in any of these increases in oil prices. I'd love to hear your thoughts in the comments below as well. Where are you seeing opportunities to invest right now? Thanks for watching. Catch you in the next video. It's not that Amazon is expanding to throttle their... Scroll up again. I'm trying to improvise on that one thing, and it's... I'm going to do this one blooper free. This whole video blooper free. Nor is it in the update... Scroll if I got to figure out how to do this. Blooper free. Industrial real estate. Did you turn the furnace off?
Yeah.
Thought I just heard it click. Okay, space. Nor is it an update from Prologis that they expect amount of oil. I don't know what I was trying to say on that one. Go through that one. Okay, there, eh?
Insert clip.
Yeah, it's, if I could only do them all like that. This all leads me to believe that supply chain issues will still reverberate through what in the hell?